Why some investors prefer holding cash. During booms, there is a moment in every bull market when the same question starts appearing everywhere. At dinner parties, in comment sections, in conversations between colleagues who have never discussed money before. The question is always some version of the same thing. Why would anyone sit on cash right now? Everything is going up. Stocks are hitting new highs. Real estate is appreciating. Crypto is making people rich overnight. The economy is humming. Unemployment is low. Consumer confidence is high. To hold cash in this environment looks, to most observers, like a combination of fear, confusion, and missed opportunity. And yet, some of the most respected investors in history, people with track records that span decades and market cycles, are known for doing exactly this. They accumulate cash during periods of widespread optimism. They reduce exposure to assets that everyone else is rushing to buy. They sit, apparently idle, while the market continues to rise around them. They get criticized. People write articles about how they have lost their edge, how their approach is outdated, how they simply do not understand the new paradigm. And then, at some point, the market turns. And the investors who are holding cash have the resources to act when everyone else is frozen in panic or forced to sell at the worst possible prices. This video is about why that happens, how it works, and what it tells us about the nature of investing, risk, and the psychology of markets. Cash is not the absence of a position. It is a position. The first thing to understand is that holding cash is not the same as doing nothing. It is an active choice with real consequences, real costs, and real potential benefits. Most people think of cash as the neutral default, the thing you hold when you have not decided what to do yet, the waiting room before you make a real investment. This framing is almost exactly backwards. In an environment where most assets are rising, holding cash has a direct, measurable cost. Every day you hold cash instead of owning stocks or real estate or some other appreciating asset, you are forgoing the gains those assets are producing. This is called the opportunity cost of cash, and during a bull market, it is very real and sometimes very large. An investor who held cash throughout the bull market of 2010 to 2020 missed out on one of the greatest sustained runs in stock market history. So why would a rational, sophisticated investor accept this cost voluntarily? The answer lies in how they think about what they are actually buying when they hold cash, and what they are actually giving up when they invest in expensive assets. The price you pay determines the return you get. This is perhaps the single most important principle in value-oriented investing, and it is the foundation of understanding why some investors prefer cash during booms. Every investment has an expected return. That expected return is not fixed. It is determined in large part by the price you pay to acquire the investment. Buy a business at a low price relative to its earnings, its assets, or its future cash flows, and your expected return is high. Buy the same business at a high price, and your expected return is low, even if the underlying business is excellent. During a boom, prices rise. This is not news, but what it means for expected returns is often overlooked. When the stock market has been rising for years and valuations have expanded significantly, when stocks are priced at 20, 30, or 40 times annual earnings instead of the historical average of around 15, the mathematical expected return from owning those stocks at those prices is substantially lower than the historical average. This is not a matter of opinion. It is arithmetic. If you pay twice as much for a stream of future cash flows, you receive half the yield. The investment may still be positive. The cash flows will still arrive, but the return on the price you paid will be lower. And if valuations contract at some point, returning to historical norms, investors who bought at peak prices may wait years or even decades to break even in real terms. The Japanese stock market provides the most extreme example. The Nikkei 225 peaked in December 1989 at nearly 39,000 points, at the height of one of the most spectacular asset bubbles in modern history. It did not return to those levels for over 30 years. Investors who bought Japanese stocks at peak valuations in 1989 spent decades waiting to recover their losses. The businesses they owned were often fine. The prices they paid were the problem. Cash in this framework is not a low-return asset. It is an asset with a known, modest, stable return. And more importantly, it is an asset that preserves your ability to buy other assets at better prices in the future. Optionality, the value of being able to act. Here is a concept that is central to understanding why sophisticated investors value cash during booms, and that is almost entirely absent from the way most people think about money. Optionality is the value of having choices. A financial option gives you the right, but not the obligation, to buy or sell something at a specified price in the future. You pay for this right up front. If the price moves in your favor, you exercise the option and profit. If it does not, you let the option expire and lose only what you paid for it. Cash functions like a perpetual option on every asset in the market. By holding cash, you preserve the ability to buy assets at whatever prices the future presents. You are not obligated to buy now. You can wait. If prices remain high, you wait longer. If prices fall, in a correction, a crash, a crisis, or simply a return to more normal valuations, you can act. The value of this optionality is not constant. It varies with market conditions. During a boom, when most assets are expensive and rising, the value of optionality is low relative to the opportunity cost of holding cash, because the prices at which you could deploy are not particularly attractive. But as a boom extends, as valuations stretch, as the gap between current prices and reasonable valuations widens, the potential value of future opportunities grows. The option becomes more valuable precisely because the potential downside from current prices becomes larger. Warren Buffett, the most widely studied practitioner of this approach, has described cash as having a call option on every asset. Berkshire Hathaway's famous accumulation of cash reserves, which reached over $100 billion at various points and attracted enormous criticism from investors who felt the money should be deployed, reflects this logic exactly. Buffett was not confused about what to do with the money. He was waiting for prices that made the deployment of that capital genuinely attractive. He was preserving optionality. The psychology of panic and the advantages of liquidity markets do not decline in orderly, rational ways. When sentiment turns, whether because of a specific event, a shift in economic conditions, or simply the exhaustion of buyers, the transition from optimism to fear can be extraordinarily rapid and extraordinarily severe. In a panic, the most urgent need for most investors is liquidity. People who are heavily invested in illiquid assets, private equity, real estate, venture capital, cannot easily sell when they need cash. People who borrowed money to invest face margin calls that force them to sell at the worst possible prices, often the most volatile assets at the bottom of the market. People who are fully invested in public markets and need cash for any reason, a job loss, a medical emergency, a business opportunity, must sell assets precisely when those assets are worth the least. The investor who holds significant cash reserves is insulated from all of these pressures. They do not need to sell. They are not forced to act. And because they are not forced to act, they can choose to act, selectively, deliberately, at prices that reflect genuine value rather than the distorted prices of panic selling. This is not just a theoretical advantage. The financial crisis of 2008 and 2009 and the COVID crash of March 2020 both created windows of days or weeks in which extraordinary assets were available at extraordinary discounts. High-quality businesses, real estate in stable markets, bonds of solvent companies, all were temporarily available at prices that reflected mass panic rather than fundamental value. Investors with cash could buy. Investors without cash could only watch or sell to raise it. The crash of March 2020 is particularly instructive because of its brevity. The market fell approximately 34% from its peak in roughly 33 days, one of the fastest declines in history. It then recovered with similar speed. The window for deploying cash at depressed prices was extraordinarily short. Investors who were waiting on the sidelines with capital available were able to buy. Investors who were fully invested going into the crash and trying to raise cash by selling were selling into a rapidly falling market and often missed the recovery entirely. The boom creates the conditions for the bust. Understanding why cash is valuable during booms requires understanding the relationship between booms and busts, a relationship that is more systematic than most people recognize in the middle of a bull market. Booms are not just periods of good economic performance. They are periods in which certain specific conditions develop that make future problems more likely. During a boom, credit expands. Lending standards loosen. Investors and businesses take on more debt because assets are rising and the cost of servicing debt feels manageable. Leverage in the system increases. At the same time, risk perception falls. People become comfortable with assets that would have seemed risky in a more cautious environment. Speculative investments, early-stage companies, highly leveraged real estate, complex financial instruments, attract capital that would have gone elsewhere in different conditions. The price of risk, as measured by the premium investors' demand for holding risky assets over safe ones, compresses. And perhaps most importantly, the pool of potential buyers shrinks. In the early stages of a bull market, many investors are cautious, holding cash or underweight equities. As the market rises and their caution appears to be costing them, they gradually capitulate and invest. By the late stages of a sustained bull market, most potential buyers have already bought. The market is, in a real sense, running out of incremental demand. When sentiment shifts and sellers begin to outnumber buyers, there is nobody left to absorb the selling. All of these conditions, high leverage, compressed risk premiums, depleted pool of buyers, mean that the potential downside in a late-stage boom is larger than it appears. And the investor who understands this dynamic, who has stayed liquid while others have fully deployed their capital, is in a structurally advantaged position when the reversal comes. Why most investors cannot do this, and why it is harder than it sounds. Everything described above sounds logical, even obvious in retrospect. And yet the vast majority of investors, professional and individual alike, do not maintain significant cash reserves during bull markets. Why? The first and most powerful reason is social and psychological pressure. During a boom, the investors who are fully invested are making money. The investors who are holding cash are not, at least not from their cash position. Every day that passes, every new high the market makes, the cash holder looks more foolish relative to their fully invested peers. This creates enormous pressure, social, professional, psychological, to deploy. For professional fund managers, this pressure is existential. A fund manager who significantly underperforms the market for 1, 2, or 3 years because they were holding cash will lose clients. It does not matter if their long-term reasoning is sound. Clients evaluate performance quarterly or annually. Institutional investors have benchmarks they must track. The career consequences of being wrong for too long, even if the reasoning is ultimately vindicated, can be terminal for a professional investor. This creates a structural bias towards staying invested regardless of valuations. For individual investors, the pressure is more psychological than professional, but it is no less real. The fear of missing out, watching assets rise while you sit in cash, is one of the most powerful and least discussed drivers of financial decision-making. It is uncomfortable to feel left behind. It is uncomfortable to watch your neighbors, your colleagues, your social media feed fill up with stories of gains you are not participating in. The discomfort of holding cash during a boom is a genuine psychological burden, and most people over time find it easier to capitulate and invest than to endure it. The second reason is uncertainty. Nobody knows when a boom will end. Bull markets can last far longer than any reasonable fundamental analysis would predict. The investor who went to cash in 2017 because valuations seemed stretched missed 3 more years of significant gains before the COVID crash. The investor who did the same in 1997 missed 3 more years of extraordinary gains in the dot-com boom. Being early is, in practice, functionally identical to being wrong, until it is not. This uncertainty is irreducible. There is no formula that tells you when a boom will become a bust. There are indicators, warning signs, historical patterns. But the timing of market reversals is genuinely unpredictable, and the cost of being early, in foregone returns, in client departures, in professional consequences, is real and can be large. The history of famous cash holders, and what happened next. The pattern of accumulating cash during booms and deploying it during downturns is not just a theoretical framework. It is a documented, repeated feature of the careers of some of the most successful long-term investors in history. Warren Buffett and Berkshire Hathaway are the most visible example, But the pattern goes further. Seth Klarman, the founder of Baupost Group and author of one of the most respected texts in value investing, has maintained cash allocations as high as 30 or 40% of his portfolio for extended periods, explicitly because he could not find investments that met his return requirements at prevailing prices. Howard Marks, the co-founder of Oaktree Capital, has built an entire intellectual framework around the concept of market cycles and the importance of adjusting risk exposure based on where in the cycle you are. Holding more defensive positions, including cash during periods of excessive optimism and deploying more aggressively during periods of pessimism and distress. The 2008 financial crisis produced one of the most dramatic illustrations of this dynamic. In the years leading up to the crisis, credit markets were extraordinarily loose, asset prices were elevated, and risk premiums were compressed to historic lows. Several investors who recognized these conditions accumulated cash and reduced risk exposure, and faced enormous professional criticism for doing so while the boom continued. When the crisis hit, those same investors had both the capital and the analytical framework to make acquisitions that generated extraordinary returns over the following decade. Michael Burry, whose bet against the subprime mortgage market was dramatized in the film The Big Short, is a different kind of example. Not a cash holder exactly, but someone who maintained a deeply contrarian position against the prevailing optimism of a boom for years, absorbing client pressure and personal criticism before being vindicated in the most dramatic way possible. His experience illustrates the psychological demands of any approach that deviates significantly from the consensus during a period of widespread euphoria. John Templeton, one of the greatest global investors of the 20th century, was famous for buying at what he called the point of maximum pessimism, the moment when fear and despair were at their most intense, when assets were cheapest and the pool of willing sellers was largest. To buy at the point of maximum pessimism, you must have had the cash available to do so. That means you must have been building that cash at some earlier point, which typically means during a period when deploying it would have seemed more immediately rewarding. The common thread across all of these investors is not a prediction about timing. None of them claimed to know exactly when markets would turn. What they shared was a discipline around price, a refusal to deploy capital into investments that did not meet their return requirements, regardless of what the market was doing around them, and a willingness to accept the costs of that discipline, including extended periods of apparent underperformance. Cash in a portfolio context, what the numbers actually show. It is worth being concrete about what the data suggests regarding cash as a portfolio component over long periods. The immediate mathematical reality is unfavorable to cash in isolation. Over very long periods, stocks have returned significantly more than cash. The equity risk premium, the additional return investors receive for holding stocks instead of safe assets, is real and has been consistently positive over most long historical periods in most major markets. Simply holding cash permanently across all market conditions would produce inferior long-term returns compared to a consistently invested equity portfolio. But this is not the argument being made by investors who hold cash during booms. Their argument is conditional, not absolute. They are not saying cash is better than stocks generally. They are saying cash is better than overpriced stocks specifically. And when we look at what happens to investors who buy assets at peak valuations, who invest at the top of major booms, the returns over the subsequent 5, 10, or even 15 years are often dramatically lower than the historical average, and sometimes negative in real terms. The research on this is fairly consistent. Cyclically adjusted valuation metrics, measures that smooth out short-term earnings fluctuations to give a more stable picture of how expensive or cheap markets are, have shown reasonable predictive power for subsequent long-term returns. When these metrics indicate that stocks are very expensive by historical standards, subsequent 10-year returns have tended to be below average. When they indicate that stocks are very cheap, subsequent returns have tended to be above average. This does not mean selling everything and holding only cash when markets look expensive. It means that a thoughtful allocation to cash during periods of high valuations, combined with the patience to deploy that cash when conditions improve, has historically been a reasonable component of a long-term investment approach, particularly for investors who have the psychological and institutional capacity to execute it consistently. What separates the investors who do it successfully? The investors who successfully maintain cash reserves during extended booms and deploy them effectively in downturns tend to have several things in common. First, they have a clear and consistent framework for valuing assets. They are not guessing about when the market will fall. They are observing that current prices imply future returns that are unattractive by their standards, and they are acting on that observation regardless of what the market does next. The decision to hold cash is not a prediction about timing. It is a response to current valuations. Second, they have institutional structures or personal circumstances that insulate them from the short-term pressure to perform. Berkshire Hathaway does not face redemptions. Buffett does not have clients who can pull their money if he underperforms for 2 years. Some of the most successful value investors operate closed-end funds or have other structures that protect them from having to respond to short-term performance comparisons. Individual investors who manage their own money and are not comparing themselves to benchmarks have a significant structural advantage over professional managers in this regard. Third, they have genuine patience, not just intellectually, but emotionally and behaviorally. The ability to sit on cash for 2, 3, or 5 years, enduring the social and psychological pressure of apparent underperformance, while remaining confident that the approach is sound, is genuinely rare. It requires a combination of intellectual conviction, emotional stability, and what some have called the psychological resilience to be wrong in public for extended periods. And fourth, they have learned from experience, either their own or studied carefully from history, that markets do eventually correct, that the corrections are often severe, and that the opportunity created by those corrections rewards the patient preparation of holding capital in reserve. The boom always looks permanent while it is happening. The correction always looks obvious in retrospect. The investors who benefit most from the gap between those two perceptions are the ones who were prepared long before the second arrived.